So to start with question 1, the heading is a cost volume profit analysis. Management set business objectives and goals to meet. A common objective of the management, the businesses, is to have maximum profit, or we say maximum return for the owners. And to achieve this objective, managements make decisions about how much they need to sell to get that target profit and what price they need to set for those goods and services. So cost volume profit analysis, or we can say it's break-even analysis, is a tool that is used to indicate the possible impact alternative courses of action will make on profits, and concentration will be given to the sales level required, how much we produce, so we break even. Break even means we are making a zero profit. Then how much quantity we need to produce, or in dollars we need to produce, so that we are able to achieve that target profit. How will a change in cost structure affect the profit? Can business justify a special pricing policy and maintain profit levels? So these are some of the things we'll be looking at under CVP, cost volume profit analysis. So cost volume profit analysis uses calculations, mathematical relationships between the elements of cost, volume is the quantity, selling price, profit, over a range of output productions called relevant range. It is important to remember that this analysis relates to the range of output over which certain costs are fixed, doesn't change over the period, and it is assumed that variable costs are constant per unit of output. It is also assumed that cost can be neatly divided into fixed cost and variable cost. So what it says is variable cost. If you are producing one, variable cost will be same if you produce two. So if for one it's $20 variable cost, so for two it will be $40. If you produce three, it will be $60. And fixed cost, it remains same. If it's $100, whether you produce one or you produce 20, your fixed cost remains same. It will remain $100. Some terms that you need to learn, understand, so you are able to understand how to do calculations on this topic. First one is fixed cost. You have to understand very well what is fixed cost. Fixed cost remain constant over a relevant range of activity. That means either you produce, like I said, whether you produce 1, you produce 10, you produce 20, your fixed cost remains same. You'll be paying same rent whether you produce in that shop, in that building you produce either 10 products, you produce 20 products, you produce 100 products, you'll be still paying same rent. You'll be still paying same amount of lease, or you may be paying same amount of insurance. So fixed cost remains same over a relevant range of activity. Then what is the relevant range? It refers to the range of output possible given firm's current resources. If production is extended beyond relevant range of output, additional investment, additional cost will be required. Like you have to, if you are producing more than relevant range, that means now you need more machines. Maybe you need another building. So this will increase your fixed cost. For another building, you have to pay rent separately. You have to pay insurance separately. If you are buying another machine, then it has depreciation cost. So your fixed costs will increase. And what is variable cost? Variable cost, it change with the amount you produce. If you produce only 10 bottles of sauce, your cost will be that much. And as soon as you produce one more, then your cost has to go up. You want to produce second one, your cost will increase. Why cost increase? Because you need to buy more materials to do that production. To produce one more bottle of sauce, you need to buy another bottle. You need to buy some more tomatoes and other ingredients. So your variable cost will change with the amount you produce. If you are engraving on bottles, so in this case, bottles become your variable cost. As you produce one, you engrave one to sell, that's your one variable cost. One bottle is your variable cost. You want to produce another one, so you have to buy another bottle to engrave. So as you want to produce more, your variable cost will also increase. Semi-variable or mixed cost. Few costs are strictly fixed or it's variable. Some per unit variable cost will increase at different output levels. Costs like electricity and telephone have a fixed line charge. We have to pay certain amount of fixed cost and a variable use charges. So if you, like for example, I have a granny flat and no one is actually renting in there, but I still have to pay bill for it. We are not using electricity there, but we still have to pay the fixed cost of $50 something every month. Though we are not using electricity, usage is zero, but fixed cost is still there. So that's what it means, semi-variable cost. It has some fixed cost. With that, there are variable charges that depends on your usage. Look at this question, which will make you understand fixed cost and variable cost better. A business has a fixed cost of 30,000 and variable cost of $2 per unit up to 35,000. So up till 35,000 you are still paying $2 per unit and we are selling it for $5. So what's your fixed cost? Your fixed cost will remain 30,000. It will remain 30,000 no matter how many units you produce. And variable cost, it's $2. So if you are producing 0, how much will be your variable cost? If you are producing 0 output, your variable cost will be also 0. If you produce 5, variable cost per unit is 2. So for 5 multiply by 2. So it will come to 10,000. If you are producing 10, so variable cost will be 10 times 2, 20,000. If you are producing 15, 15 times 2, so it will be 30,000 and so forth. So how do we calculate total cost? Total cost is made of a fixed cost plus a variable cost. And how do we calculate total revenue? It's price, the price at which you are selling, times how many you have produced. So how much will be your revenue when you are doing 0 production? If you are not producing, you haven't produced anything, so you are not selling. So your revenue will be 0. So 5 times 0 will be 0. If you are producing 5, so you'll be selling those 5, you'll get 25,000. So this is what your answer will look like. Fixed cost remains same. No matter how many we are producing, it remains same. And variable cost, it increases with increase in production. And our variable cost per unit is $2. So if you are producing 5,000, so 5,000 times 2, it's 10,000. If you are producing 10,000, 10,000 times 2 is 20,000. So our variable cost increases with increase in production. And one important thing you have to know, variable cost will be 0 when we are not producing. We haven't produced, so there is no variable cost. Only we'll have a fixed cost. And total cost, as I said, fixed cost plus variable cost gives you total cost. 30 plus 20 gives you 40. 30 plus 20 will give you 50, and so forth. Total revenue, like I said, if you are not producing, you are not selling, your revenue is 0. And our selling price in this question was $5. So if you haven't produced anything, times 5, it will be still 0. If you have produced 5,000, you are selling each at $5, your revenue will be 25. So if you look at the table here, your cost and your revenue compare. So you can see your cost is increasing and your revenue is less. Your cost is more, your revenue is less, so you are making a loss. So business is making loss up till 9 units. And once they produce the 10th one, at 10th one, their cost and their revenue is same. That means they are making 0 profit. Revenue and cost is same. So they are making 0 profit, and that 0 profit is called break even. Output at which businesses are making 0 profit, it's called break even. So which output they are making 0 profit? At output 10 they are making break even. And after break even, if you produce any additional output, you'll start to make a profit. So after break even, revenue becomes more and cost will be less than revenue. So you start to make a profit after break even. Before break even, it's a loss. For same information, now we can put it in graph form. Fixed cost, it remains same. No matter how many we produce, fixed cost remains same. Variable cost, it will start here at 0. When we are producing 0, our variable cost will be 0. So this is our variable cost. Total cost starts at fixed cost here because our total cost is made of fixed cost plus variable cost. Even if we are producing 0 output, we have some fixed cost. So our total cost starts there. It will be always more than variable cost. Fixed cost plus variable cost will make up the total cost. And at output 10, businesses are making a break even. These red dots, that's the revenue. Revenue also starts at 0 because when we are doing 0 production, our revenue